All right, regardless if you're an entrepreneur or you're an investor looking at investing in SaaS businesses, one of the most important metrics that you need to keep track of is your gross or logo churn. So gross churn or logo churn is simply the number of companies that have dropped off of your platform or revenue that you have lost within a given cohort over a certain period of time, not accounting for any increases in contract value from those same customers. So for example, you start off and you say, given in this period, like Q1 of 2023, I ended the quarter with this many contracts. And if I fast forward 12 months, how many contracts do I still have, right? That is the idea behind logo churn. From a revenue perspective, you would say, let's say you have 100 customers and each customer pays you $1 per year. I don't know what they're paying you just $1 per year for, but let's say that's the type of software you sell and how you priced it. So under gross churn, if you have 10% annual churn, then that would mean that after a year, you would start with 100, and after a year, you'd have $90 left. 90 customers, each paying you $1 each. And then if those people then churn again by 10% in the next year, then you would be left with 89, and so on and so forth. Now, why do VCs care about logo churn and or gross churn? Well, the reason is that it can be incredibly helpful in terms of determining the stickiness of your product. Do customers really like what they're buying? The other type of churn that's often quoted and is also super important is revenue churn or net revenue retention, which is kind of an inverse of churn because it's typically when you are generating more revenue than is lost by those that leave. And so your churn rate actually looks negative, even though you do have real churn. And so it's not uncommon for entrepreneurs to say, oh, we have negative churn, and bury the fact that they actually may have very high logo churn. Ultimately, logo churn is not a short-term problem. It's a long-term problem from the perspective of if you are constantly losing customers, that means that you either haven't built a very good product for your customer's need, you're targeting the wrong customer, which may be also the case. It could be that you're not doing a very good job of onboarding customers and getting them fully integrated and using the product. It could be that you're not very good at renewals. And it could be that you haven't appropriately priced the product relative to the amount of value that your customers are getting out of it. So logo churn can be incredibly helpful in terms of determining how good of a product you actually have and how good a product market fit you have. And it was one of the reasons why a lot of VCs will spend time trying to understand what your logo churn really looks like. Ultimately, if you want to increase your lifetime value of a customer, focusing on logo churn can really help you do that. Because if you have relatively low logo churn, then that would infer that customers are are staying with you over the long run, regardless of whether or not they're expanding their contracts. Eventually, here's the problem. Eventually, most businesses are going to get to a saturation point where there's no more revenue that a company can generate from them as a customer because all the users have the product and all the users are using all the features. And when that happens, what can happen is what's been your revenue churn and has looked fantastic because it's been negative because they keep buying more products and adding more users over time. That can invert as they hit that saturation point, and all of a sudden your logo churn starts to take over and drive real problems for your business if you haven't been proactive about managing it very early on. That said, look, some level of churn is always expected. And the reason for that is because you can't control what goes on in other businesses. Sometimes those businesses fail. So I would expect to see much higher levels of logo churn for a business that caters to SMB sized businesses because smaller businesses, medium-sized businesses are more likely to fail than larger businesses. The other time you see it is when a company gets acquired, and sometimes the acquirer will come in and they'll totally flush the entire tech stack and replace it with their own solutions. That's kind of outside your control. So there's this concept of like regrettable logo churn. Regrettable logo churn is where you lost the customer, but you really wanted to keep them, versus non-regrettable churn, which is the company went out of business, or in some cases, it's a customer that decided to fire. You fired them because they were too costly, they were too problematic, they had higher churn rates, broadly speaking, as a category than what you want. And I've seen that happen with a lot of companies where they've made a transition from selling to SMBs, for example, to moving to enterprise software clients. And during that process, they have insane logo churn, but it's offset by the revenue churn or the net revenue retention that they're getting from their larger enterprise clients. And in that case, it's okay, but you need to understand the story of what's going on there and why logo churn is so high. And not just chalk it up necessarily to this transition, but really digging in and understanding why that is the case. Generally, I like to see logo churn that is less than 10% annual for an enterprise software business. And then it can go quite a bit higher, probably, something in the 30% range for SMBs on an annual basis. Anything higher than that, and you start running into this problem of like you're losing more customers than you're able to gain in that same time period, and it just becomes like this uphill battle for customer acquisition. Anyways, if this was helpful to better understand how logo churn or gross churn works, be sure to check out some of my other SaaS metrics videos, like how SaaS valuations have changed over time. Thanks.